Some huge swings, a lot of uncertainty. We're now looking at a really critical period for the market.
Definitely.
And you, our listener, gave us a whole stack of sources, articles, research, analysis, all pointing at technicals, macro events, and what the big money is thinking.
Right. So our mission today is really to cut through all that noise. We're going to distill the key data points, the technical levels to watch, and the sentiment signals you really need to understand where we stand right now.
And we're going to be zooming in on the big indices, what the Federal Reserve is up to, and this huge policy mandate that some analysts think could completely change the game long
A
term.
really big one.
But before we jump into any of that, we always have to start with a disclaimer.
Of course. This deep dive is for educational purposes only and is not financial advice.
Perfect. Okay, let's get into it. I want to start with the index performance because November showed this really interesting split.
A real divergence, yeah.
The S&P 500, the SPY, it kept chugging along, finished the month higher, kept that winning streak alive.
It did. But then you look over at the NASDAQ, at the QQQ, and it snapped its streak.
Right, its first red month since March.
Exactly. And what a lot of the analysts in the material you gave us are pointing to is what that means. They're calling it a clear sign of increased breadth.
Increased breadth. We hear that term a lot. For everyone listening, that basically means the rally is getting healthier, doesn't it? It's not just relying on 7 giant stocks anymore.
That's it, precisely. When the S&P can climb, while the NASDAQ, which is so concentrated in big tech, takes a bit of a breather, well, it suggests the capital is moving around.
Rotating out.
Rotating out of those high-flying, magnificent 7 names and into other sectors, maybe cyclicals, maybe small caps, the names that have been lagging behind.
And that kind of rotation, that's usually a good sign, isn't it? Shows some resilience.
It does. It shows a trust in the broader economic picture. Investors are looking beyond the stocks that have already, run up 100% this year.
Okay, so technically speaking, where does that leave us at the start of December?
From a pure charting perspective, both the SPY and QQQ are still in a very strong macro uptrend. The sources describe it as an ascending channel. So every time it pulls back to the bottom of that channel, buyers step in, hits the top, people take some profits.
And the SPY is getting pretty aggressive right now.
Very aggressive. It is threatening its all-time highs. The ATH is 689, and we closed just around 683. We are right there, knocking on the door.
And the VIX, the fear gauge, it's pretty calm.
Yeah, it's back down around 18. That tells us there's less immediate anxiety in the market.
Okay.
Now, when the VIX is low, it can mean complacency, or it could just mean there's a shared belief that no big, nasty surprises are on the horizon. And that kind of clears the runway for more gains.
Assuming the catalysts line up.
Assuming the catalysts line up.
And speaking of catalysts, there's nothing bigger this week than the Federal Reserve. We've got a huge 48 hours coming up, starting tonight, Monday.
That's the first major hurdle. Fed Chair Jerome Powell speaks tonight at 8:00 p.m. Eastern.
And the market has priced in a lot of good news.
A huge amount of optimism. So if he comes out and sounds hawkish, restrictive, it could easily unravel this recent rally. We could see a pretty quick sell-off.
Because his words are being weighed against these incredibly high odds of a rate cut.
Exactly.
How high are we talking now?
They've jumped dramatically. We're now seeing projections of around an 86 to 90% chance for a 25 basis point cut.
Yeah.
And that's for the FOMC meeting that wraps up on the 10th. This shift is massive because it changes how institutions allocate their money.
Right. If rates are expected to fall, growth stocks suddenly look a lot more attractive.
Immediately. Their future earnings are worth more today.
We also have another big liquidity signal happening. The end of quantitative tightening, or QT.
This is such a crucial point, and it's often misunderstood.
Yeah, let's break it down.
So during QT, the Fed was actively shrinking its balance sheet. They were, in effect, draining money from the banking system.
Making credit harder to get?
Exactly, making things less liquid. So when analysts talk about the end of QT, which quietly started on December 1st, they describe it as loosening the belt.
So it's not printing new money, but it's stopping the draining process.
Precisely. It ends the deliberate suppression of liquidity. It gives banks more credit, more oxygen for lending and investing, and that is inherently bullish for risk assets like stocks.
And there was more, too.
Yeah, to reinforce that, we saw commentary from Fed Williams hinting they might even expand the balance sheet again.
So really turning the tats back on.
Potentially. You combine that with a falling dollar, which is good for multinational profits. You have 3 powerful monetary signals all pointing the same way. More liquidity is coming.
Okay. So technicals look good, rate cut odds are high, liquidity is returning. But now we have to talk about the huge non-market catalyst detailed in the sources. This political policy push, the Genesis mission.
This is the kind of thing that overrides the short-term noise. It's critical if you're investing in tech for the long haul. President Donald J. Trump signed the Genesis Mission Executive Order.
And this isn't just a proposal.
No, this is a national mandate. The goal is to accelerate the build-out of the world's most powerful AI infrastructure.
So what does that actually look like in terms of, money and requirements?
It means mandatory government funding flowing directly into what are now being called AI-first sectors.
A directive.
It's a directive. We're talking exactly. It's like how huge government contracts propped up the early aerospace and defense industries back during the Cold War.
So government necessity is basically an insurance policy for your revenue.
That's a great way to put it. Analysts in the materials are calling this a tsunami of mandatory spending that will last for years. One even suggested the impact could be bigger than the dot-com bubble.
Wow. Bigger than the dot-com bubble.
Or even rival the industrial revolutions. It guarantees the AI trade has legs, even if the broader market takes a hit.
That context is so important, especially when you look at the mixed signals we saw in investor sentiment last week.
It's the classic pattern. It really is. Retail traders were the biggest net sellers last week.
They were selling.
They were selling. Driven by fear, by volatility. They panicked when stocks dropped 10 or 15%.
And at the same time.
At the exact same time, hedge funds and institutions were the biggest net buyers. They were aggressively loading up.
So retail was dumping shares, and the pros were just scooping them up. Did that fear stick around?
Not for long. The Fear Greed Index already shot back up from 5 to 20. The immediate panic is over.
I see.
And the sources suggest this just confirms that institutions are positioning for what's next. They're anticipating a necessary healthy correction, not a blow-off top.
Setting the stage for rallies into 2026.
Potentially, yeah. Assuming that structural support from the Genesis mission holds firm.
Okay, let's get granular. Let's look at a specific stock highlighted in the sources. Meta, ticker MEA. It's had a pretty big run.
Meta is a perfect case study here. It's a beneficiary of that AI mandate, but it's also been volatile. It ran up hard, hit $648 recently.
So that's a level to watch.
$648 is the key resistance. If it can break and hold above that, technicians see that as a trigger for a move up towards $670.
And what if it pulls back before it gets there?
The immediate support level is $636. Now, if Meta closes below $636, analysts are suggesting it could actually be setting up a very bullish long-term pattern.
Okay, how so?
It would likely dip briefly to form what's called the right shoulder of a potential inverse head and shoulders pattern.
All right, we need to unpack that. What is an inverse head and shoulders, and why is that bullish?
So it's a classic reversal pattern. It signals the end of a downtrend and the start of a new uptrend. You get 3 dips.
A lower low, then a higher low.
Exactly. The left shoulder, the head, and then the right shoulder. When that right shoulder forms, it confirms sellers are exhausted and buyers are stepping in at higher prices.
So a short-term drop is seen as the last gasp before a bigger breakout.
That's the idea, a breakout that would target that 200-day moving average, also around $670. And don't forget, some analysts are still citing a long-term target of $1,000 for Meta, tying it directly to that Genesis tailwind.
Let's quickly hit a few other stocks you pulled from the sources.
Sure. We saw some incredible divergence. Eli Lilly was up almost 46% in 2 months. Meanwhile, SMCI, another AI player, was down 46% in the same period.
That's wild. Shows how fast that rotation can be. What about UPS? I saw a note on that.
Yeah, UPS is still showing some technical opportunity up to the $50 range. That's after a very rare pattern, an inverse island candle, which predicted a big gap up.
An inverse island.
It's a strong reversal signal. The stock gaps down, trades in a range, then gaps back up, leaving that range isolated on the chart. It's a very powerful sign.
And earnings. Anyone important this week?
Earnings are definitely key. CrowdStrike, CRWD reports tomorrow after the close. Sentiment seems to be leaning bullish, partly because of those AI and cybersecurity mandates.
Okay.
Also, CRDO, that's Credo, is one to watch with earnings this week. It's been stuck in what analysts call a chop and slot box, just trading sideways, waiting for a catalyst to break it out.
All right, let's pivot to the long-term philosophy here. The sources really hammer-home this idea of buying corrections, not chasing new highs.
It's that counterintuitive idea. When there's blood in the streets, it's time to eat. The long-term strategy is to dollar cost average in when good stocks are down 5, 10, 15, or even 20%. That 17 to 20% dip is often the sweet spot. It's the point of maximum fear, which means it's also the point of maximum opportunity.
So based on the last 30 days, that period where retail was selling and institutions were buying, which of the big names are in that deep discount zone?
This is where it all comes together. The technical pullback meets that fundamental AI policy. The analysts are pointing to major AI players hitting those buy zones. Palantir, PLTR, is down 14% in the last 30 days.
So getting close.
Sitting around $169, that's a huge discount from its highs, especially when you remember it used to trade at $8 or $12.
And Meta, which we just covered, is also in that territory.
Correct. Meta's down 13.5%. Then you have AMD, which is down almost 18%. It's right on the doorstep of that 20% ideal buy zone.
And NVIDIA
is down over 16.5% in the last 30 days.
So you're telling me the market is giving a 15 to 18% discount on the very companies that are basically guaranteed government demand for the foreseeable future.
That is the synthesis the sources are presenting. These pullbacks are being seen as temporary shakeouts, not a fundamental shift in the trend. And that trend is now backed by some pretty unprecedented political and monetary tailwinds.
So as we head into December, we've got this weird disconnect, institutional optimism clashing with leftover retail fear, all while this massive policy is pouring fuel on the fire.
We are in what the sources call a confusion period. It's intense, but likely temporary. The institutions are looking past it, positioning for 2026 by buying these dips.
But when you add it all up,
You put it all together. The Genesis mission, rate cut odds near 90%, QT ending, institutions buying. It's all lining up for what is historically the strongest month for inflows into the market. The environment suggests any short-term pain is really just creating long-term opportunity.
which leaves a really important final thought for you, our listener. How do you manage your own emotions when all the big signals point up, but the market tries to shake out the weak hands by giving you a 15 or 20% sale on your favorite names?
That exact moment of maximum panic is historically the moment of maximum opportunity.
Focus on the mandate, not the momentum. Stay disciplined.
Thanks for listening to the 15-Minute Investor.